So for the rest of this chapter, we are going to talk about the cost of capital, but we are going to separate the cost of capital into several parts. First, we are going to learn about the cost of equity, and then we are going to learn about the cost of debt and the cost of preferred stock. And now we are going to, at the end of our chapter, we are going to combine these three costs of some kind of capital into a single concept called weighted average cost of capital. So let me start with the cost of equity. So the cost of capital is the required return of the investors of a company, and that will be used in a situation where the company needs to evaluate a project. So it needs to have a discount rate, and in that case, that discount rate can be used by the cost of capital. And because by the term capital, it means the funds raised by the company. Basically, you have two different kinds of capital. You have equity capital, you have debt capital. By the term equity capital, it means you are using the money from your own shareholders, and the shareholders are the owners of the company, so they are your money actually. And on the contrary, you have debt capital. The debt capital is the borrowed money. So you borrow some money from the bank or from the capital market by issuing bonds, and those funds are basically you borrowed, so you have to pay back in some day. And the cost of capital is a wide concept covering from the cost of equity capital to the cost of debt capital. So because a company has both equity and debt, you need to mix. You need to add them together, and you need to find out the average capital, and that will be the weighted average cost of capital that we are going to learn at the end of this chapter. So let me start with the cost of equity. The cost of equity, as the name implies, this is the equity investors' required return, and the equity investors will be your shareholders because they are purchasing your shares. So the company needs to satisfy them because they expect to earn some money by putting the money into your shares. The problem here about the cost of equity is that it is not observed usually. So we have to get some estimates, or we have to get a predicted value about the cost of equity from the market situation. And there are several approaches to determine the cost of equity. The first one is dividend growth model, and the second one is the capital asset pricing model, and we are going to talk about them together. So first, dividend growth model. This is actually what we learned from the financial management course. So basically, you have a share. If you have a share, stock or share, then if you hold some shares, then you will receive the dividends. And these dividends will be your cash flow. Therefore, you can calculate your expected return by comparing the stock price and the dividends amount. And that's the core of the dividend growth model. So if you want to know more about the dividend growth model, you can take a look at chapter 8 in your textbook, and from that chapter we can learn that the cost of equity should be, or the return of your investment for a stock should be D1 over P0 plus G, where D1 is the expected dividend, and the P0 is the current stock price, and the G is the growth rate of the dividend. So suppose there is a company called Greater States Public Service, and it paid dividend $4 per share last year, and the stock price is $60 per share currently, and the dividend will grow steadily in a constant rate of 6% per year. And if someone asks you about the cost of equity for Greater States, then you can rely on the dividend growth model, because you have the all information required for the dividend growth model. So first, you have to calculate the expected dividend, or the dividend in the next year. Please note that the paid dividend of the last year, $4, is already paid, and this is not the thing you want to use. You have to think about the future dividend. So because the dividend is growing at a constant rate of 6%, it means the $4 will also increase at a rate of 6%. Therefore, the expected dividend for the year is $4 times 1 plus 0.06, because of the 6% growth rate, and it should be $4.24. And then you can use it into the equation we learned. So the cost of equity is the D1 for the $4.24 divided by the current stock price, $60, plus the growth rate of the 6%, and then you will get the 0.1307. So by using the percentage scale, the cost of equity, or the required return from the stock, is 13%. So this is very easy to rely on the dividend growth model to get the estimated cost of capital, because what you need to know is about the dividend and the current stock price. But there are also some disadvantages in the DGM, the dividend growth model. First, the dividend growth model is only applicable to companies that pay dividends. Some companies pay dividends, but others don't. In that case, what you get from the dividend model is because there is no dividend, D1 should be 0, and that should be 0 divided by the stock price plus 0, because again there is no dividend, so the dividend grows at 0 rate. So actually the return becomes 0, and this is a nonsense. Therefore, the dividend growth model does not predict the company's cost of equity when there is no dividend at all. And another issue in using the DGM is that we have to figure out the growth rate. So in the previous calculation, we used the growth rate 2 times. First, we used the growth rate of 6% when we want to calculate the future dividend, and at the same time, we also added once again in the calculation of the cost of equity. Therefore, it is essential to get the precise growth rate from the company's information. However, sometimes companies increase dividends and then suddenly they decrease it. So there is no constant growth rate as you can expect from the theory. Therefore, because of the problem, relying on the dividend growth model can be problematic because the growth rate is not accurate. So that could be another problem in the DGM model. And then what else can we do? We can rely on the capital asset pricing model, or in short CAPM or CAPM. This this is what we learned in chapter 13, the chapter just before our beginning of our semester. So according to the CAPM model, the cost of equity should be written like this. The cost of equity is RF, which is the risk-free rate, plus beta, which is times RM, the stock market's average return, minus the risk-free rate again. And by the way, here we have RM minus R half, this term, and we often denote this term as market risk premium. So let me briefly introduce what the meanings are. First, the risk-free rate means the basic return or the basic interest rate that you are expecting if you are putting your money in an asset which has no risk at all. And then for your investments in other assets, generally those assets have some kind of risk, therefore you expect more from those assets. Therefore, the risk of return, the return of the asset becomes larger and larger. And then, because we are thinking about the stock market, we have to consider the stock market average return. And the beta is a measure of the risk of your company. So by aggregating them all, you can calculate the cost of equity, which is about the risk-adjusted return of your company's stock price. So let me just give you an example. So suppose there is a company named Walt Disney. I guess that you already know the names of the company. And this Walt Disney has a beta of 1.11. And then the market risk premium is 7%. And the US Treasury bills are paying at 1.53%. And then you can calculate the Walt Disney's cost of equity by using the capital asset pricing model. First, you need the risk-free interest rate. The risk-free interest rate sorry, the risk-free interest rate does not exist in reality because generally any kind of assets has some kind of risk. However, alternatively, we can consider the US government to be risk-free because nobody thinks that the USA will go bankrupt. So we can just believe that the US Treasury, which is a bond issued by the US government, is some kind of risk-free asset. And therefore, we are going to use the US Treasury's bills rate of return as a proxy of the risk-free rate of return. And then the cost of equity is 1.53 because this is the risk-free interest rate, plus beta 1.11 of the Walt Disney times, here we need the market risk premium, which is the difference between the market return and the risk-free rate. And we already know the market risk premium itself, so this is 7%, and we put the number, and after calculation we get the cost of equity as 9.3. So many of you may wonder, how can we get that result from the CAPM model? So let me just briefly review about the CAPM. So if you invest in a stock, there are two kinds of risk. The one is called systematic risk, and the other is unsystematic risk or diversifiable risk. The systematic risk is the risk that occurs because you are investing in a stock market, and therefore this is a market-wide effect, and almost all single stock will be affected by this kind of risk. For example, this symbolizes the fluctuation in your global economy, or the war between some countries, or the skyrocketing oil prices. Every global macroeconomic factors are included in this kind of systematic risk. And then you have another risk, which is unsystematic risk, and that affects only a small or a single number of assets at a time. And the thing is, actually, the unsystematic risk is not that important, because by diversifying your portfolio, you can remove it. So diversifying means you are not investing in a single asset, but you are investing in multiple assets together. So let's say you are doing a business, so you are selling umbrellas, or you are selling ice creams at a zoo park. And then if you are selling only your umbrella, then you cannot sell anything when it is sunny. But at the same time, when you are only selling your umbrella to the people, then you will have a trouble. When you are selling your ice cream, and you will have a trouble when it's rainy day. So therefore, maybe you can think about combining these two businesses, and you are selling both umbrellas and ice creams together. And then you have no problem at all, because whenever it is sunny, you can sell your ice cream, and whenever it's raining, you can sell your umbrellas. So in any days, you can learn some of your fortune. So that's the kind of diversification we can find from the real life. And it can also be applied to the stock investment. So you don't invest in a single stock, something like Tesla. You can invest in Tesla. You put some of your money in Facebook, and some other money in Google, some other money in Amazon. And then by doing so, you construct a portfolio, which means the composition of the stocks you want to invest. And by doing so, you can remove some special risks that are only related to your assets. And they are unsystematic risk. So therefore, actually unsystematic risk can be removed, and therefore they are not that important. And what matter is only the systematic risk, because it cannot be removed, because still we are investing in a stock market. So in a nutshell, the asset's expected return depends on the systematic risk. So if you are having more systematic risk, your return should be higher. And if you have smaller, or if you have lower systematic risk, your expected return should be lower. So that is a basic principle, that we have return and we have a risk, and there is a proportional relationship between your return and the risk. If you take it all, then you can earn some money. But if you don't take any risk, then you are safe, so you don't have to lose your money. But at the same time, you cannot earn additional money from your investment. So by taking your risk, you can earn more, and that risk is only related to the systematic risk. And here, the beta symbolizes the systematic risk. This is the measure of the systematic risk. So, and then if we believe that the beta is a measure of the risk, then we can think about a ratio about my return and my risk. So here on the upside, we have return minus RF, the risk-free rate. So this is the expected return, the excessive risk excessive return that we can earn from our stock investment, and on the downside we have beta, which is the risk that we are taking. So let me draw a graph of this ratio. For some assets, it will be something like this line. So you have more risk and you have more return. So by investing in an asset A, you will get this kind of reward to risk ratio. And let's say you have another asset named B, but this is the graph but with different slope. So let me compare these two different assets. So for the company A, if you invest in stock company A, then for the risk you are taking, you are earning this return. But for the B, you are for the same, exactly the same amount of risk, you are only getting a return of a smaller amount. And that's not fair for me, because I'm taking the risk, so I want to get a adequate return or the compensation from the risk. So therefore, I prefer asset A, but I don't like to invest in asset B, which means every single investors will think the same, and therefore everyone will rush to purchase stock A while everyone will avoid stock B. And then there comes the magic of the economics. So in economics, we learn about the supply and the demand. So we have more demand of A. It means the price becomes larger and larger, and then suddenly the return starts to decrease. So eventually their reward to risk will be the same. So therefore we will get the same reward to risk for two different assets, and that will apply to every asset in the market. So in an efficient market, the reward to risk ratio should be the same for all assets, and it creates our CAPM model. So on the left side, we have a specific stock for our company, and on the right side, we are considering a portfolio composed of all stock market. So this is the market, stock market itself, and on the left side we have our company. And these two, again, they have the same reward to risk ratio, and that will be written as this equation. So we have RE, the cost of equity, minus RF divided by the beta of the company, and we have RM, the market return, minus the RF, risk-free rate, divided by the market beta. But here the market beta should be 1, because market systematic risk is the market itself. Therefore it is 1 and we don't have to care about it. And then if we multiply beta on the both sides, we get this kind of equation by rearranging this, and that's called as the capital asset pricing model. So the cost of equity or the required return should be the risk-free rate plus beta times the the market risk premium. Okay, so we have finished the cost of equity. So in wrap up, you can rely on the dividend growth model or the capital asset pricing model when you want to calculate the cost of equity. And then let me move on to the cost of debt. Similarly to the cost of equity as the required return from stock investors, the cost of debt is the required return from the creditors. or the debt holders. Cost of equity is more complicated because it is not observed, but we have to figure it out. But the cost of debt is more straightforward because generally it is observable from the bond market. So what we use is the yield to maturity of a bond of the company's existing, in other words, outstanding bond. Or if a company does not have an outstanding bond, then you can alternatively look at the competitors or the peer companies' cost of debt, and then you can use it as an alternative measure of the cost of debt. So what's the yield to maturity? The yield to maturity is the discount rate calculated directly from the bond price. The bond price is here, and by having a bond, we are expecting to get the interest and the face value of the bond. So the coupon is the interest that we can earn from the bond, and they are earned in the later. For example, maybe you will receive a semi-annual coupon, which means you will get the coupon 2 times in a year, and until it matures, and when it comes, you will get you will receive the face value, which is the original money you borrowed, you lended to the company. And by calculating the present value of the coupons and the face value, you can get the present price of the bond, and in that case, the R is the discount rate, and that discount rate is called as the yield to maturity. But yield to maturity is more easier than the capital asset pricing model because generally the bond market also provides the information regarding their yield to maturities of all bonds existing in the bond market. So you don't have to calculate it by yourself. So if you get the number about the yield to maturity from the bond market, then you can just use it as the cost of debt. However, one thing you have to remember about the debt is that there is a effect about your tax payment. So that's the interest tax shield. So when a company has a bond or other kinds of borrowed money, then it does not have to pay a large amount of taxes to the government because they are going to treat the borrowed money as a accrual deduction before you calculate your tax. So basically, in a net income statement, you calculate your corporate tax after you deduct your interest expenses, and that reduces your after-tax income. And by doing so, before the tax income, so you don't have to pay much taxes to the government. So let me give you an example. So consider 2 identical companies from U and L, and the only difference between these 2 companies is that firm U is unlevered, so in other words, it does not have no debt. On the other hand, we have firm L, levered one, which has outstanding bonds of $800 with an interest rate of 10% per year. And then let's assume that they are identical in their cash flow generating ability. In other words, their profitabilities are the same. So their EBIT, earnings before interest and taxes, will be the same as $1,000. And the corporate tax rate is assumed to be 21%. And then let me compare the two companies' income statements. First, we have firm U, and it does not have debt, so we don't pay interest in that company. So taxable income will be 1,000, and then the taxes will be calculated based on the taxable income, based on the corporate tax rate of 21%. So they have to pay $210 as the tax, and the net income will be 790 as a remainder. On the other hand, think about the firm L, levered company. So it has the same EBIT. However, the difference is that now it has a bond of $800. So for each year, it pays interest to the bondholders, the amounting to $80, because 800 times 10% is 80. And now the taxable income of the company is 920. So it is smaller compared to firm U. And therefore, the taxes are calculated based on the reduced taxable income, 920. So you have to pay taxes of $193 approximately. And this is smaller compared to firm U's tax expenses. So but therefore we can say that firm L was able to save the taxes by having corporate debt. So that's the tax shield effect. So again, the difference between the net income is $63, and this arises from the interest tax shield, which can be calculated by following this formula. So the bond amount, the total bond, $800, times the average interest rate, 10%, times 1 minus tax rate, 21%. And then you get the difference, the $63. And precisely, the tax savings is $800 times 10% interest rate times the tax rate. So it is $16.80. So we are going to think about the cost of debt, but at the same time now later we are going to think also about the interest tax shield effect. So there is a benefit of having that in our company. So finally, we have preferred stocks cost. So the cost of preferred stock is also straightforward. This is a rate of return required by the preferred stockholders. The preferred stockholders' preferred stock is generally a kind of equity capital, but it has a characteristics that resemble the debt. So in short, preferred stock pays a fixed amount of dividend every period, and it rarely changes. So at the same time, the preferred stock so this is similar. This is a security just between the equity, the common stock, and the bond. And the cost of preferred stock is therefore can be calculated as the dividend, which is the fixed amount dividend paid to the preferred stock divided by the price of the preferred stock. Now we have three different costs. We have cost of equity, the required return from the stock investors, the cost of debt, the required return from the debt holders, and finally we have cost of preferred stock, the required return from the preferred stockholders. So now we are going to combine those three things together to get the final cost of capital for the aggregate firm. So let me describe it in an example. So let's say we have a company XYZ, and this company has outstanding debt of $100, and its equity is worth $200. So in total, its asset value should be $300. But among the equity, $150 is common stock, and the rest, $50, is preferred stock. And corporate tax rate is 30%. And there are three different kinds of investors for this company. They are first, common stock shareholders require 20% returns. Maybe we have obtained this number from the CAPM, but we don't know. And we have preferred stockholders requiring 12% return. And finally, we have creditors requiring 10% returns. And then what we want to calculate is what is the average or what is the return that XYZ needs to have to satisfy every investors. So first, shareholders, because they put $150 into the company and they want to earn 20% return, what they expect is $30. The preferred stockholders put $50 and they expect 12% return, so they want to have at least $6. Finally, the creditors expect to have 10 because they put $100 to the company and their expected return is 10%. And then overall, the company needs to have 30 plus 6 plus 10, which is 46, in order to satisfy those three different groups of investors together. However, actually, XYZ does not need to earn 46 precisely, because actually we can enjoy the benefits from the debt, which is interest tax shield. So XYZ can save some taxes. It means our net income can be decreased. The amount of the interest tax shield is the $100 bond times 10% return times 30% tax rate, and this is $3. So the XYZ's minimum return is now reduced from 46 to 43. And yes, okay, so let me go back to the previous slide about the interest tax shield. So the tax savings is here $16.80. So this is the difference between the $210 and 193.2. So this is 116 $16.80, and that can be obtained by the debt amount times the debt interest rate times the tax rate. So we are doing the same calculation based on the new numbers. So now we have debt 100, so 100 times, so and the interest rate is 10% for the creditors, so we use 10%, and finally the tax rate is 30, so we use 0.3. Okay, so we are getting the interest tax shield amounts to $3, and the minimum required return for this company is $43, and what they had is $3,300 because they had debt of $100, equity 150, preferred stock 50, so 200 plus 100, 300 over 33. Their rate of return is 21.5%, and this 21.5% can be obtained by the calculation through the process. But if I do not do the if I do not get the numbers from time to time, but I do the calculation, but in a final version I can write down it like this calculation. So I first calculated the equity, the common stock times its rate of return, and then I also calculated the preferred stock times preferred stock's required return. I also calculated the debt times interest rate, creditor's rate of return, and finally I had the interest tax shield effect, 100 times 10% interest rate times 30% tax rate, and I had this one plus this one plus this one minus this one, and then I divided that with regarding to our total asset size, which is 300. So this is exactly the same calculation we had to obtain 21% rate of return. And now let's change the order of our calculation. Now we are going to calculate this one first, because you have multiplication and you have this kind of numerator. So if you divide 150 with 300, it does not matter. And you also calculate this one first. You also calculate this one first. And finally, you calculate this one first. And then it should be something like this. So you have equity value divided by the total asset, the preferred stocks value divided by the value of the firm, the debt value divided by the total value of the firm, times each multiplied by the cost of equity, cost of preferred stock, cost of debt, and by the way, you have 1 minus TC here because you had a interest tax shield effect. So that's the final formula for the weighted average cost of capital. So this is the average of cost of equity, cost of debt, and cost of preferred stock. However, by using their proportions in assets as their weight. So you have cost of equity, but by having this kind of weight, you have preferred stock, but you have to use the weight here. And finally, you also have a cost of debt, but regarding to relative to the debt proportion in the asset. Okay, so let me give you a new example. So consider Eastman Chemical. So this company has 136 million shares outstanding, and currently the stock price is approximately $78, and the last dividend payment was $2 per share, and the earnings growth will be 4%. Beta is given here, and the market risk premium is 7, and treasury bill interest rate is 1.5. and it has also bonds worth of $4,000 million, and average yield to maturity is around 30%, and the corporate tax rate is 21%. And you have a lot of information. So first of all, you can begin with the calculation of cost of equity by using the CAPM. So by using the CAPM, you know the US Treasury bills interest rate, and you know the beta, and you know the market risk premium, and so by using these numbers, you get 10% cost of equity from the CAPM. At the same time, you can also rely on the dividend growth model. So because it also pays the dividend, so the last dividend was 2.48. So the next dividend will increase according to the growth rate of the dividend, and the current stock price was $78 approximately, and you add the growth rate again, and you get the 7.58% as the cost of equity based on the dividend growth model. So now we have two different numbers. So in practice, you can genuinely rely on one of two methods, but here now we don't know which one is correct or not, so we are just going to use the average of them. So I'm going to use the cost of equity of 8.93 because this is the average between CAPM model and dividend growth model's return. And I want to calculate the weight, the proportion of the equity. So currently there are 100 million shares, and each of the stock worth $78. So the value of equity is $10 billion, and therefore the weight is, here we have equity value and we have bond value divided we have this, by adding them we get the total asset size, and we want to use it here, and by dividing our equity value with the asset size, I get the equity accounts for 71%. That means the debt will account for the rest, 29%. And then the weighted average cost of capital is 71% because this is the equity weight, and 8.39, which is the cost of equity obtained from two methods, and 29%, the proportion of the debt, and 2.98, this is the yield to maturity, and times 1 minus t to consider the interest tax shield effect, and we get the average cost of capital is 7%. So we are going to use this as the discount rate when evaluating investment projects. So that's why we are learning the weighted average cost of capital.